I hope we can start, right?
Yes,
Okay,
ma'am.
those who
Yes,
can,
madam. Good.
those who can respond, please respond. Others, please listen. Okay. Can I have an idea about your understanding regarding corporate financial management? Have you learned it before?
No.
No. Okay. Then today I'll give you a brief introduction of the corporate financial management and the functions related to that. Okay, if you have a paper or a book or something like that, you can write down the important topics or titles. I hope you know what is financial management, right? Okay, financial management is about managing the funds, and corporate financial management is about the financial management of a corporate or an organization, right? Okay. First, let us see the functions of financial management. If you're learning financial management, or if you take a textbook, or if you take a syllabus of any university, you can see the syllabus is divided into different modules, and those modules will be the functions of financial management. Okay, let us see what are the functions of financial management. Basically, to start an organization or to invest somewhere, you need fund, right? That is a fundamental thing. Okay, to start something, you need fund. Okay, that is also required for an organization. To run the organization, you need fund. So that what will be the first function? What can be the first function?
Raising the
Raising funds, right? Okay, the first function can be raising of funds. Okay, how can you raise fund? With respect to a joint stock company, what are the sources of funds? The sources of funds comprises of uh, issue of equity shares or issue of preference shares, or it can go for debenture issue also. Uh, Hope you have an idea about what is equity, what is preference share, and debentures. Equity means if a company issue shares, equity shares, the buyers of equity shares will become the owners of the company. They will get the voting right, and they can take part in the decisions of the company. That is what is an equity shareholder. And the company can raise fund from the public in the form of preference share also. Preference shareholders are not having the voting right. They are not having the ownership right. But they will get a preference at the time of distribution of the profit. That is why they are known as preference shareholders. And even at the time of winding up of the company, they will get a preference. Okay, why preference shareholders are known as preference shareholders? Because they have two preferences. One preference is with respect to the distribution of profit. Okay, they will get the portion of profit distributed as dividend after meeting the interest expenses of the debenture holders. That is why they are known as preference shareholders. And even at the time of winding up of the company, they will get the preference. Then what is the other source? Debentures, right? Issue of debentures. Okay, this is also another source of fund for an organization to raise from the public at a large. Then what is how debentures are different from shares? How is it different? Equity or preference is in the form of capital, and this is also known as capital, but it is a debt fund. Okay, what is it? Okay, if a company issues shares, equity shareholders will get the right of owners. They'll get ownership right, and preference shareholders will get a preferential right. At the same time, if the company issues debentures, they are issuing a debt capital. They are raising fund through issue debt. Okay, and there are some obligation regarding the debt issue. When the company issues debt, it should be repaid. It should be repaid after a particular period of time. Usually, it is after 5 years or 7 years. The company has to repay it, and at the time of distribution of profit, it is obligatory to distribute the profit in the form of interest, and the payments are fixed also. That is one of the disadvantages of debenture holders. That is, they cannot enjoy the surplus profit. Okay, whatever is agreed by the company in the form of coupon rate or interest rate, that the debenture holders are eligible for that. Only they cannot enjoy the excess profit. Only the equity shareholders can enjoy the surplus profit. Okay, hope you got an idea how an organization, how a joint stock company can raise fund, right? What are the sources?
Yes.
Yeah. Yes, please.
So, madam, what is the benefit for this debenture holders?
The benefit for the company is like uh, the payment is fixed. Once the interest rate is fixed, when at the time of issue itself, if you buy a debenture, in debenture certificate itself, the rate is mentioned, and the another advantage is that interest payment is tax acceptable. Okay, the company can enjoy tax exemption on interest payment. That is the advantage of company. Hope it is clear. Yes. I can't hear you properly. Could you please repeat?
If the company goes bankrupt.
Bankrupt. It is mandatory for the company to pay the interest, debenture interest. That is why the company should be cautious with respect to issue of debentures, because it is the obligation of the company to pay the interest, but it is not mandatory to pay the equity dividend, because equity shareholders are the owners. Owners has the responsibility. Owners have the responsibility to bear the risk. That is why equity dividend is not mandatory, but the debenture interest is mandatory. Payment is mandatory. Okay, that is why it is not good to have more debt. Okay, we should analyze the financial position of the company before issuing debentures. We should ensure that the company is in a position to pay back its debt. Okay, then okay, we are going to discuss the functions of financial management, right? Okay, the basic function is, the first function is to have funds, right? That function is known as financing function. What is financing function? It is the function of raising funds. When to raise, how to raise, all these decisions are known as financing decisions. Then, okay, you have enough fund with you. You have decided to issue shares or preference shares or debentures. Okay, then let us discuss another term related to financing decision. Have you heard of capital structure decision? Financing decision is more technically known as capital structure decision. I'll tell you what is capital structure. Capital structure is the proportion of debt and equity in the capital structure. Okay, as finance managers, you may have to take a decision. How much equity is to be issued, or how much preference share is to be issued, or how much capital is to be raised as debt capital. Okay, how will you decide this? How will you decide this? Okay, that depends upon two aspects. One is cost of capital, and the other one is market value of the firm. Okay, I'll tell you what is cost of capital. These are the two deciding factors with respect to how much debt should be there, how much equity, how much preference share should be there. Okay, what are the two differentiate or two factors we have to consider? Cost of capital and what is the other one? Market value.
Market.
Market value. Yeah. Cost of capital, I'll tell you what is cost of capital. Cost of capital is a minimum expected rate of return of the investors. What is cost of capital? It is a minimum expected rate of return of the investors. Here, who all are the investors? Who all are the investors? If the company issues shares, I can purchase shares, right? Then I'll be the investor. And what do you mean by investment? Investment means you are spending money, right? You are investing means, okay, you may be spending your hard-earned money, and for every investment, you will expect an appreciation. Why you are expecting an appreciation for your investment? Why?
There is a
Because
profit.
yeah, you need profit. Why? Because uh, you are spending your money or investing for a, maybe for a long term period. Even if for a short term period, there are risks also involved in that, right? Since there is risk, and future, we know future is always uncertain, and uh, because of inflation, your money value may also go down. Okay, so that you need to have a compensation for that. That is why we expect a profit. We expect an appreciation of whatever you spend or whatever you invest. Okay, that is what is cost of capital. What is cost of capital? It is a minimum expected rate of return by the investor. And who all are the investors here? Equity shareholder or preference shareholders or the debenture holders. These all are the investors, right? And based on the investors, the cost of capital can be like cost of equity, cost of preference shares, or cost of debentures, or we otherwise known as cost of debt. Okay, hope you got it. What is cost of capital? It is a minimum expected rate of return by either an equity shareholder or a preference shareholder or the debenture holders. Then, what is the other aspect of deciding the capital structure? That is market value of the firm. Okay, as finance managers, you have to focus on the optimum capital structure. What is the optimum capital structure? It is that proportion of capital structure where you have the minimum cost of capital and maximum value for the firm. I hope it is clear. What do you mean by optimum capital structure? It is that proportion of capital structure where you have minimum cost of capital and maximum value of the firm. Okay, hope uh, you got an idea about the financing decision. What is financing decision? Financing decision is about the sourcing decision. From where to raise the fund, when to raise, how to raise. All these are known as financing decision of the firm. And it is also known as capital structure decision. What is capital structure? Capital structure is a proportion of debt and equity in the capital structure. Okay, listen. Okay, based on the cost of capital and the market value of the firm, you can decide, okay, let us have 60% equity or 20% preference share, and the rest can be equity debt. Okay, like that you can decide, or you can decide like with we can go for 100% equity. Like that you can decide, right, based on the cost of capital and market value of the firm. Then okay, you have raised enough fund. Now you have enough fund with you. Then what is the next step you can take? You have fund, right? Then what should be done then? You have to invest this in wise projects, right? You have to invest the fund, because you have already raised the fund, right? Then you have to feasibly invest it. That is the second function of financial management. What is that? Investment decision. And based on the time frame, we can have two kinds of investment decision: short-term investment decision and long-term investment decision. Okay, let us discuss short-term investment decision first. A short-term investment decision is also known as working capital management. Okay, have you heard of this working capital management?
Yes.
And yeah,
Yes.
what is working capital? What is working capital? It is the minimum capital required for the day-to-day operations of the business. What is working capital? It is the fund required for meeting the day-to-day operations of the business. Okay, what can be the day-to-day expenses of a firm? Can you give examples? Day-to-day
Salary.
expenses. Salary. You have to. Okay, usually, what is the routine activity of a business?
Purchase.
Usually, yeah, in
Like
a
raw,
manufacturing, yeah, in a manufacturing organization, you have to purchase raw materials, and you will be converting that to, first you have to convert that to work in progress, then again you will convert that to finished products, then you will sell it. That is a routine activity happening in a manufacturing organization. Okay, for that you have to purchase the raw material. That is your routine activity, right? You purchasing raw materials, and you have to pay salary, and you have to settle the bills, like you have to pay the electricity, you may
Utility.
have to, yeah, pay the fuel bills. All these are your day-to-day expenses. Okay. What is working capital? Working capital is the management of day-to-day expenses. Okay. Then, how can you calculate working capital? Is there any formula to calculate working capital? Okay. We can calculate working capital as current asset minus current liabilities. What is current asset? What is current liability? Any idea? Current assets, current liabilities. Current assets are those assets which can be converted into cash within a short period of time. Okay, for example, most of the organizations will be selling their products or the services, rendering the services on credit, right? Okay, and if you sell a product today, or if you render a service today, you'll be getting the sales proceeds after the completion of the credit period. You may allow the customers to have a credit period of 15 days or 30 days, even 45 days, or like that. And you'll be getting the amount only after the completion of the credit period. And there is a time lag is there, right? And but we know that we can convert it to cash. Those assets which can be converted into cash within a short period of time is known as current asset. And like that, what is current liability? Current liabilities are those liabilities which has to be settled within a year. Okay, and how can you calculate working capital? Working capital is the difference between current asset and current liability. Okay, hope it is clear. Okay, we are discussing investment decision. In investment decision, based on the time frame, we can divide it like short-term and long-term investment decision. Short-term investment decision is known as working capital management, and that is about management of cash, management of receivables, management of inventory and all. Then, okay, let us go to the long-term investment decision. The long-term investment decision is known as capital budgeting decision. Okay, what is long-term investment decision? It is known as capital budgeting decision. Okay, I'll tell you what are the capital budgeting decision. Like it can be a decision for the modernization of the firm. Okay, for modernization, you require huge amount, right? And the benefit of modernization you can enjoy for a long period of time. Such expenses are known as long-term investment. Or you can expand your operations, like you can open up a new branch in your own country, or you can have operations in overseas also, or you can invest in another project, or you can expand your product line. All these are investment which requires a bulk amount as well, or a lump sum amount, or the benefit can be enjoyed for a long period of time. Such expenses are known as long-term investments or capital budgeting decisions. Okay, what are the examples for capital budgeting decision? Expansion decision. Then, or you can have acquisition or mergers. All these are long-term investment decision. Okay, hope it is clear. Or you can go for an automation decision. Automation also requires huge investment. Okay, these kind of decisions are known as long-term investment decisions or capital budgeting decision. And how will you take a long-term investment decision? Okay, in financing decision, we have discussed about two aspects. What were the two aspects in financing decision? What were the two aspects? Cost of capital and market value of the firm. Yeah, like that. Here we have to consider two things: risk and return. Okay, in long-term investment decision, what are the two basic criteria? Risk and return. What do you mean by risk? What do you mean by risk? Because we are talking about long-term investment decision, right? And long-term investment decision can be, we are spending a huge amount for a long-term period. And we know that future is always uncertain and we don't know about the future, right? You may get back the amount or you may not get back the amount. You may end up in loss. These are the risks associated with that, right? Okay, basically, risk is about the uncertainty of the future. Risk is happening due to the uncertainty of the future. And that is why we should be careful with respect to a long-term investment. And we know that there is time value of money also. Okay, what is time value of money? Okay, if you invest 5 lakh today and you are expecting a return for 5 years, and you are getting 1 lakh income in the first year, second year you may get 1.5 lakhs, and third year you may get 2 lakhs, like that. But can you compare your earnings in the first year with the earnings in the fifth year? Can you compare? Are they equal? Okay, suppose you got 1 lakh in the first year. Then you again got 1 lakh in the fifth year. Uh, is the 1 lakh in the first year the same as a 1 lakh in the fifth year?
May
Are
not
they
be
same?
because
No.
of the inflation.
No.
Yeah, may not, because there is
Inflation.
there can be a devaluation due to inflation, right? Okay, so that we have to consider the time value of money also. Okay, these are the things we have to consider while we go for a long-term investment decision. And long-term investment decision is known as capital budgeting decision. Then, okay, we have done which all decisions we have completed? Which all decisions?
Financial decision.
That is not financial, financing decision.
Okay.
Financing decision, yeah. Then we have sourced enough fund, then we started investing it, right? And investment decision can be short-term and long-term. Short-term investment decision is known as working capital management, and long-term investment decision is known as capital budgeting decision.
Yep.
Now, you have enough fund, you have invested wisely. Then what is the next step? What is the next step? You may start generating profit, right? If you have chosen the correct investment alternative, definitely you may start getting profits. And what do you have to do with that profit? Profit has to be, any idea? Profit has to be,
Yeah,
Reinvested.
Reinvested.
it can be reinvested. It can be reinvested, or it has to be distributed to the owners, right? Yeah,
Hmm.
it has to be
Yes,
distributed
dividend.
to the owners in the form of dividend. Okay, that is the next function. And the third function is known as profit allocation decision. Profit allocation decision. Okay, here, what you have to decide is like, okay, someone responded like you have to reinvest it. Someone responded like it has to be distributed, right? Okay, we have to do both. As finance managers, you have to do both. It has to be reinvested and it has to be distributed also. Okay, that is what is known as profit allocation. Allocation means a portion has to be distributed and the rest has to be retained. Okay, this is also known as dividend allocation and retention decision. Allocation and retention decision. Okay, listen. In most of the growing companies, a portion of profit is retained. And what do you call that retained portion is known as retained earnings. Why we are retaining a portion? Because you are in a growing phase. You may find more investment opportunities. At that time, this can be used as a source of fund. This retained earnings can be used as a source of fund. That is why we retain a portion of that. And basically that belongs to the equity shareholders. And what do you call the distributed portion of profit? It is known as dividend. Okay, hope it is clear. Okay, we have broadly discussed the uh, functions of financial management. What are the functions we discussed so far? First function is financing decision. And technically, what will you call that financing decision? It is also known as capital
Capital structure.
capital structure decision. And what is capital structure decision? It is the proportion of debt and equity in the capital structure. And you have to take that decision based on two aspects. What are the two aspects? Cost of capital and market value of the firm. Yeah. And what is the optimum capital structure? What is the optimum capital structure? It is that proportion of capital structure where you have minimum cost of capital and maximum value for the firm. And what is the second function? Second function is known as investment function. And in investment function, you have to take short-term investment decision, long-term investment decision. Short-term investment decision is also known as working capital management. And how will you calculate working capital? Working capital, how will you calculate? What is the formula? Current asset minus
Current asset minus
current
current liabilities.
liabilities.
Yes. Then what do you mean by long-term investment decision? What will you call that decision?
Budget.
Capital budgeting decision. Capital budgeting decision. Thank you. I feel happy that you are responding. Long-term investment decisions are known as capital budgeting decision. And how will you take a capital budgeting decision? Based on what you can take a decision? Risk and return aspect, right? Based on risk and return, you can take a capital budgeting decision. Then, after that, what you have to do? You have to distribute the profit, right? To whom you have to distribute? To whom you have to distribute the profit?
Shareholder.
Equity
The
holders.
shareholders in the form of dividend. That is why that function is known as either profit allocation decision or the retention and distribution decision. Okay, there you have to decide how much is to be distributed as dividend and how much is to be retained as retained earnings. Okay. Now, I'll show you an Excel sheet. Let me share that. Please respond if you can see the Excel sheet.
Yes, ma'am.
Yeah, mom.
Yes,
Yeah,
sir.
mom is visible.
Okay, thank you. Okay, we have discussed about the entire calculation. We cannot discuss in one class. Okay, now I'll tell you how to calculate the return as an equity shareholder. You can calculate. This is with respect to the equity shareholders. Okay, I'll show you an Excel sheet regarding the calculation of return. Okay, listen. Suppose you have purchased shares of a company. You can calculate the return from that shares. It is like that. These are the inputs given. The first column is 6 years. You are holding. What do you mean by this 6 years? You are holding that share for 6 years. Okay. It is your long-term investment. Okay, you are holding a particular share for 6 years. And the second column is about dividend per share. DPS means dividend per share. Okay, you are earning 18.5 as dividend in the first year.
It's a
13,
percentage, ma'am.
no, it's not percentage. 13 you are getting in the second year, 15 you're getting in the third year, 16 you're getting in the fourth year, like that. Sixth year you're getting 20. Okay, it can be in whatever currency, rupees or whatever dollar or any, it's not percentage. Okay, listen. And these are the share price. These are the market price. In the first year, the market price is 466, then 604, like that it is increasing. And you want to know the dividend yield as well as capital gain or loss. Okay. Every year you can calculate your yield. What do you mean by yield? Yield is your income, right? Income. And these two are expressed in terms of percentage. Okay, why we have divided your yield or income into two? Okay, listen. Basically, if you are investing in a share, or even if you are investing in a bank account, okay, you can have a fixed deposit also, right? Okay, wherever you invest, either in shares or in fixed deposit, usually there will be two streams of inflows. Okay, let us consider fixed deposit first. Okay, you have deposited 5 lakh and it can be for 5 years. And in every 5 year, you will be getting an interest amount, right? That is your regular return. That is your regular return. And at the end of the 5th year, you will get the principal amount back. That is what is known as capital gain. Okay, these are the two streams of inflows. Okay, here also you can see two streams. We have divided your return into two, dividend yield and capital gain. Okay, here, since it is a share, it can be loss also, right? We know that capital market is highly volatile. Okay, in some years, it can be loss. That is why gain or loss is shown here. Okay, dividend yield, what is it? Dividend yield means, what is that? That is your regular return. Okay, what is dividend yield? Dividend yield is your regular return. Okay, how can you calculate your dividend yield? Dividend yield is calculated as dividend by P0. Okay. First year you cannot calculate the dividend because you want to know the previous year's figure also. That's why we start the calculation from the second year. Okay, here, how did you get 2.15? You got it by dividend by
Dividend.
P0.
Dividend.
Dividend by P0. Okay, 13 is the dividend of that year, dividend by P0. Then How will you calculate the capital gain or loss? The
From the
formula
share
is like
price.
P1 by P0 divided by P0. P1 is the price of this year or current year. P0 is the previous year's price divided by P0. Okay, like that you can calculate it for the except first year, you can calculate it for 5 years. Then you can find the total in this column. The last column is you'll get it by adding your two streams of inflows, dividend as well as capital gain. Then these are the usual calculations to compare your or your to express your return. Okay, usually we can have an average. Okay, how will you find the average? Average means total divided by number of years, right? Okay, and I hope you know the Excel function for average.
Yes, ma'am.
Yeah, you know.
Ma'am, one question.
Yes.
Now we are saying term as a capital gain or loss.
Capital
Instead
gain,
of
yeah.
capital gain or loss, we can
Hmm.
say this is ROE, return of equity.
Yeah, that is also another expression. That is also another expression of return. A return we can calculate in different ways.
Okay, but the calculation is
ROE, yeah.
different, right?
We usually use ROE also, return on equity. So that is another expression. Okay, these are the basic things. ROE is also used to express the return from equity shareholders. Or that is specific to equity, ROE. And whatever investment you have, we can have ROI also, return on investment. Return on investment. Yeah, that is a general expression. Then standard deviation also we measure. Standard deviation is a measure of risk. Listen, here, both the calculation you can see, both the return as well as risk aspect. Okay, here, the average or the dividend yield or capital gain or return, you express it for the calculation of return. And standard deviation and variance is a measure of risk. Okay, how will you find out this? Standard deviation. For this also we can use the Excel function. Then variance also you can use. Okay, I'll show you the formula. You can do it manually or you can do it with the help of Excel function. Okay, when you do it manually, this is the formula. And okay, we usually in Excel you can see two options. Sample variance and sample population, population variance. And with respect to standard deviation also you can see sample, standard deviation and population. Okay, you have to consider sample variance and sample deviation. If you do it manually, you can use this formula, or if you want to use the Excel function, I hope you can see formula here. Are you able to see the formula? Yeah, equal to, I have clicked here in variance column. You can see the formula is equal to variance. Yeah, I'll do it like here. Okay. Equal to variance. VAR. When I type here, you will get two options, variance.p and variance.s, which you have to take variance.dot.
Can
Sample
you share
variance.
this sheet to us also?
I didn't get you.
Please share this Excel sheet also.
Yeah, I'll give this to your institution. They
Okay.
will share it. Okay. Then you just want to select the range. Okay, the bracket will get automatically opened there. Then you have to select the range. Okay, this is the range. I hope it is clear. You can try it later. Then like this, you can find standard deviation also. Okay, when I enter equal to, then when I type standard deviation. Okay, this Excel function equal to STDEV. Okay, here also you can see two options, dot P and dot S. Okay, you select dot S and you just select the range. Okay, like that you can do the calculation with the help of Excel functions. Okay, hope it is clear. Okay, if you are a shareholder, you can calculate your risk and return using either Excel, or you can use for calculating the risk, you can use this formula if you want to do it manually. Okay, for your university exams, you may have to do it manually, right? Or if it is for practical application only, you can do the Excel function. Some universities may allow the Excel calculations also. That depends on your university. Okay, hope it is clear.
Clear, ma'am.
Then I'll show you few more things. This is with respect to calculation of risk and return. Then I have told you, no, for every long-term investment decision, you have to refer the time value of money also. Time value of money is also important. Okay, I'll show you that also. Okay, for every long-term investment decision. A long-term investment decision can be your personal financial investment decision, or as finance managers, you may have to take a decision for your organization also, right? Okay, this concept is applicable for your personal investment decision as well as your corporate decisions, right? Okay, you may be knowing about two branches of finance, like personal financial planning. You can be a personal financial planner, or you can be the financial manager of an organization, right? Okay, these are few of the practical application of time value of money. Okay, I'll show you 2-3 examples. We'll get an idea about how to calculate time value of money. Okay. Basically, time value of money is about the calculation of future value and present value. Okay, future value means if you're getting 5 lakh at the end of the 5th year, 5 lakh at the end of the 5th year, that is expressed in future value. And you want to compare the investment with the return after 5 years. You have to compare your outflow and inflow in the same term, like either it should be in present terms or it should be in future terms. Usually we all convert future value to present value. And you may be knowing about compounding and discounting. What is it? Compounding and discounting. Compounding is a process of converting present value to future terms. And discounting is the process of converting future value to present terms. Okay, I'll show you how you can convert present value to future terms and future value to present terms. Okay, let us go through this example. Hope you can see the Excel sheet, right?
Yes, ma'am.
Yes.
Okay.
Yes.
If the interest rate is 5%, $100 today is basically equal to dash 1 year from now. Okay. You are, let me adjust the screen. Okay. You are investing $100 today at the rate of 5%. Okay, you want to know how much you will get after 1 year. Okay, what is this calculation? 100 you're spending now, right? 100 you're spending now, and this is in present terms. You want to know the future value of this 100 at the rate of 5% interest. Okay, for that, you have to find the future value, and that process is known as compounding. And yeah, if you want to do it manually, you can apply this formula. F is equal to P into 1 plus R raised to N. I'll tell you the notations. F is equal to future value. P is a present value. R is a rate of return, and N is the number of years of compounding. Okay, here in this example, can you distribute the values here? F you want to find out, right? If you invest 100,
P is
F-
100,
yeah, P is 100, R is
R is 5%,
5%, and N is 1.
N is 1 year.
1. If you want to do it manually, you can apply this formula, or I'll show you the Excel formula also, Excel function also. Yeah, please see this. Okay. I'll reduce or I'll zoom it out so that you can see it in a single screen. Okay, hope you can see it, right? Okay,
Yes,
present value. Present value is 100. You are investing 100 today. That is expressed in terms of present value. And NPR means number of periods or years. You are investing it for 1 year, and the expected interest rate is 5%. Then you want to find the future value. Okay, this is the formula to find the future value. Okay, hope you can see the Excel function here.
Yes, ma'am.
FV into, yeah, I'll show how to calculate that. You just enter equal to here, then type FV. FV means future value. Yeah, double click on that function, then this formula will appear. You just want to click the values. You just want to select the cells. What is the rate here?
5%.
5%. Yeah, let me, let me, C11, C11, right? Okay, the cell address should be correct. Either you can type it or you can select the cell. I just selected the cell. Then put a comma here. Then what is NPR here? Number of periods. 1.
C10.
Yeah. C10. Yeah, I'll select that. Then it will automatically come. Comma. PMT. PMT, I'll tell you. Usually there are two streams of either inflow or outflow. Okay, like PMT means annuity. Annuity payment. I don't know whether you are familiar to this term, but we all are familiar to that kind of inflows and outflows. Okay, I'll tell you like if you have taken a loan, you will be paying equal amounts monthly, right? What do you call that? EMI.
EMI.
Equated monthly investments or equated monthly installments. That is an example of annuity because you are paying. That is your outflow, right? Okay, it is an equal amount of outflow. Then for that is an example of outflow. If you have deposited an amount in your fixed deposit in a bank, you will be getting regular interest and you'll be getting the same amount every year or monthly like that. That is an example of
Inflow.
Equal amount of inflow. Okay, I'll tell you what is annuity. Annuity is either either inflow or outflow of equal amounts for a definite period of time. That is what is annuity. But here, in this case, you are spending 100 rupees or whatever it is only once. This is not an annuity. Or if you are investing 100 rupees or $100 every year or every month, that is a case of annuity. Okay, this is a lump sum payment. This is a one-time payment. That is why in this case, PMT will be 0.
0.
Hope it is clear. PMT is 0, comma. Then PV is given in a bracket. Why? I'll tell you. Here, what in this case, whatever you want to convert to different terms, that has to be mentioned in minus. Okay. Here, what do you want to convert?
100.
100. That is in present terms. You want to convert that to future term. So that you put a minus here. Minus. Then select that cell. That is why PV is given as
C9.
bracket. Yeah. C9. Then put a comma. Then here, type is also 0. 0 means type is also applicable for an annuity payment. Here, this is not an annuity payment. This
Okay,
is a
end
lump
of
sum.
period. It's 0 means end
Yeah,
of period.
0 means end of the period, and that too is applicable for the annuity. Here in lump sum payment, you can take it as 0. Put a 0 here. Then close the bracket and press enter key. You will get the value. This is how you calculate future value. Hope it is clear.
Yes, ma'am.
Yeah, what do you mean by
Yes.
105 here? If you invest 100 rupees at the rate of 5% for 1 year, you will get a value of
The
100.
future value is 105. Yes, what you will
Yeah,
receive.
okay. 105. Okay. Okay, you can do it either manually or with the help of Excel function. Then let us go to an example of present value calculation. Yeah, let us see this example. Okay, you are given with 4 options. Which of these is most valuable if the interest rate is 10%? Okay, these are the options. $800 today. You can choose among these 4. Either you can go for $800 today, or $1,000 3 years from now, or $2,000 10 years from now, or $3,000 20 years from now. Okay, which do you think is better? Can you give a
800
guess?
Already answer is given there only. Case 2.
800
$800 today.
Yeah.
Why? How did you take a decision? By simply looking at the figures? Yeah, basically, we cannot take a decision like that. Why?
We have to calculate it.
Yeah, you have to convert this to all these two, because 800 is in present terms, right? 800
Yes.
is in present terms, 1,000, 2,000, 3,000, everything is in future terms. So that
Yes.
you have to convert all these into present value.
The present
Okay,
value, yes.
yeah. Let us see an example that how you can convert a future value to present terms. And this is similar to the previous calculation. I'll just show you how to do that. Yeah, see this table. Future value is 1,000 and the number of years 3, interest rate 10%. And you have to find the present value. Okay, I'll just type the formula here. This is just similar to the calculation of FP. Enter equal to, then we want to find present value, right? Type
Yes.
PV here, then, sorry, PV. Then the formula will appear, the function will appear, double click on that. Then you can see the
Wait.
rate. What is the rate here? 10%. You just click
10%.
there. Yeah.
Yeah.
Click,
Say
put a
what,
comma. NPR is
3 years.
3, comma,
Six.
put a comma. Yeah. Here,
Yeah.
PMT is also 0, right? This is also a lump sum payment. Not
Yes.
an annuity. Not an annuity. PMT is also 0. Put 0. Then comma. Then FE is given in bracket because we want to convert that to present term. So then put a
Yes.
minus. Then select FE. Put a
Yeah.
comma. Yeah. Then type is also 0. Then enter it. Then if you get 1,000 at the end of 3 years at an expected rate of 10%, how much how much is the worth? It is having a worth of 751. Is it?
Yes. Yes.
Then the 800 is better than this, right? Then
Yes.
like that, let us see the other values also. Okay, I have done the calculation. I'll just show you that. 2000. Let us see how 2,000 is, how much 2,000 is worth and how much 3,000 is worth when you get 20 years later. I'll just show the figures. Hope you got the calculation, right?
Yes, ma'am.
Okay, this is a value of 2,000. Okay, if you receive 2,000 at the end of 10th year at the expected rate of 10%, it is having a worth of 771.
Yes.
Yeah. Then if you get 3,000 at the end of 20 years at the expectation of 10%, it is having only a worth of 445. Then which one will you prefer? Because you have already told the answer.
Yes.
Yeah, this is a comparison. This is a comparison chart. These are the options in front of you. Either 800, you can receive 800 today, or you can wait for 3 years, but you will get only 751. If you wait for 10 years, you will get only the amount you receive at the end of 10 years is only having a worth of 771. Then
Yes.
if you wait for 20 years, it is having a worth of 445. Then as layman, we may choose to have a different answer, but from now you can do like you know how to calculate it, right? How to compare it. Okay,
Yes.
now we can see that 800 is better, right? Compared to other options. Okay, this is how we can apply the concept of time value of money. And this is with respect to our individual decision. Usually we use the concept of time value of money in the case of capital budgeting decision also, because every long-term investment decision, either your personal financial investment or your corporate financial investment decision, everywhere you can use this concept. And in that case, in an organizational context, it is like the calculation of capital budgeting, NPV, IRR. Someone might have heard of that, right? Net present value, internal rate of return. For all these calculations, we can apply the concept of time value of money. Okay, today there is no time to discuss that aspect. I hope it is clear till what we discuss.
Yes, ma'am.
Okay. I think it's your time. Okay, let me stop sharing. And do you have any doubts?
Yeah, if you can share that Excel sheet, we can go through it.
Yes, sure.
On this one.
Yes. Hope you had some learning, right?
Yes,
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 ma'am.
ma'am.
Okay.
Yes,
Thank you
thank
so
you.
much.
Thank you.
Thank you. Thank
Thank
you.
you. Thank you.
Thank you.